I'd like to thank everybody for joining me today. Today, I want to talk about income tax planning. As we are approaching year end, it's that time of year where everybody gets excited about getting their taxes as low as possible. So, as we start thinking about taxes and how we plan, let's look at some of those opportunities. If we think about taxes, especially as we're preparing for our tax planning, there's two types of taxes that erode our income. There's both the income tax and the capital gains tax. And that's what we focus on mainly because on December 31st, we've either done a lot of this planning or our options on limiting that income tax exposure is going to be reduced. So if you start thinking about that, I've got four areas that we want to look at here. First is in the qualified plan area. With qualified plans, of course, we know traditional IRA and Roth IRA, you can do those even if you're, not working, if you're not employed. You can do a Roth IRA, you can do a traditional IRA. You can also roll your traditional IRA over to the Roth IRA and pay that tax now versus later. But I also look at this if you're a business owner, can you do more to offset some of those business taxes? And so, offering a 401k to your employees, it's a start. Then you can include a profit sharing plan. But a lot of clients don't understand they can do a defined benefit plan. And with a defined benefit plan, this works good with businesses that are higher income with few employees, and a lot of times with the owner being an employee, that they have a larger income than most of the employees. They're older than most of their employees, and therefore they can put more of that money away from them. And it can be significant. Two, three, $400,000 can go into your defined benefit plan. And so if you want those kind of deductions, that's a nice place to start looking for tax savings. Also, if you're doing a defined benefit plan, you can add for a 401h plan to that defined benefit plan. And 401h is for post retirement medical expenses. And I like this because it's deductible now. And if as long as you're using that for post retirement medical expenses, then that's not going to be treated as income as you use those funds. So it's a great way to create tax deductions now that are going to be used for those benefits in the future. The other one that comes to mind is charitable planning. And charitable planning, you might be making direct gifts to charity. And a lot of that happens between now and the end of the year. With your direct gift to charity, a lot of people don't think about this and they just, write the charity a check. It's a dollar for dollar deduction. It's a gift to charity. But if you think about that gift to charity, well, you could take some, take look at your investment portfolio, and if you have a stock or mutual fund that has significant gain in it, and if you take that out, you're going to have to pay the tax on that gain. Well, take that, gift the charity your stock or mutual fund. They get that at fair market value. Your deduction is based on fair market value. You're not taxed on that building gain of that security. And if it's your favorite stock, go rebuy it again. So gift it at the fair market value that is significantly over what you paid for it. And if you want, go ahead and replace it in your portfolio. And you've now used leveraged money to fund your charitable contributions. You can give money to a donor advised fund, and that will be triggered as a charitable deduction this year. Then you can decide which charities you want to give that to over the next years. But I also like using charitable remainder trust. This is a great way to put money or um, assets that are going to be sold. You're going to move them into the charitable remainder trust. You get to take a deduction now based on what will be potentially given to the charity in the future, but it allows you or your spouse jointly to receive income from that charitable remainder trust for your life or for your joint lives, and the charity gets whatever's left in the trust at the end. So the charity doesn't get anything now. They only get it when the person or people have passed away. So it's a great way to create that income during retirement, defer the gain on a large sale, like a sale of a business or sale of a large asset, but still have that retirement income that you need in your retirement years. A charitable lead trust is kind of the reverse of that. In a charitable lead trust, you're going to move assets or money into that trust now, and you're going to set up a payment out to a charity for the next, say, 5 to 10 years, whatever you want. And the charity gets to use that money now. And at the end of that trust term, whatever's left in the trust comes back to you there again to be used, for retirement or whatever your needs are. And for larger clients, I like looking at private foundations as a way to um, make more of a charitable intent and charitable legacy, but you're doing it with bigger dollars, and this might be make fit may be a fit for some clients. There's also business strategies we can look at, to reduce your taxes now, improve the, overall, after tax ability of this business to grow, and give less to Uncle Sam, more, keep more in the business. I like captive insurance companies as a way to, mitigate the risk to the business and to potentially create some tax deductions that are going to be beneficial to the owners of the business. Accelerated depreciation. A lot of businesses will go and buy assets, buy trucks, buy equipment, those things to accelerate depreciation now. What they may not know is you can do a cost segregation, and a cost segregation is used on real estate. So with that, think about you've bought an apartment complex. Well, you can either straight line depreciate that over the next 39 years, or you can do a cost segregation, and anything that would be treated as 15-year or less property for depreciation, you can take that deduction now. So it's a way to create, large depreciation deductions now versus stretching them out over a long period of time. It's a great time now to look at ESOPs to see if it's time to transition your business. Does it make sense to sell your business to an ESOP, protect your business legacy, protect your employees, provide them benefits for their retirement, but also as an ESOP, and you can be an 100% S Corp ESOP, and that business will no longer be subject to state or federal taxation. So those are good things to look at. Research and development credits. There again, if you're building your business on research and development and creating processes in your business, you might be entitled to credits that can offset current year taxable income. This is a good time to look and see if you're operating as an S corporation, would it make sense to operate as a C corporation and be able to, be taxed as a C corporation at 21%, or, the owners of the company being subject to the tax at the individual level that can be significantly higher. And so all of these are business strategies that give us opportunity to plan. Finally, I like to throw life insurance in here. Now, life insurance is not going to create a deduction today for our taxable income problem. But if we're looking at setting things up to the future, we can design a life insurance policy to mimic what a Roth IRA is going to do, grow that cash investment, tax deferred, be able to access it tax free, and also be able to create that as estate tax free. So it's a great way to leverage dollars for the future for both our business and our family. In most states, that is already creditor protected. But this is an asset that can be funded by the business in a split dollar plan, an executive bonus plan. But it is a great way to be planning for that future income tax problem today, so that we don't have the big tax into the future. So as you look at your tax planning, look at the opportunities to plan now and defer or eliminate income in the income taxes and plan for the future so that you can have the retirement that you want. So I appreciate everybody being on. If you have questions, reach out. If not, we'll talk again next week. Thank you.